Welcome! Today, we're diving into the world of finance to understand a term you've probably seen on credit card statements, loan offers, or mortgage documents: annual percentage rate, or APR. Knowing what APR means and how it's calculated can help you make smarter decisions when borrowing money or comparing financial products. In this video, we'll break down the concept of APR, show you how it's calculated, and explain why it matters for your financial health. Let's get started by defining exactly what APR is. APR stands for annual percentage rate. It's a standardized way to express the yearly cost of borrowing money, including not just the interest rate, but also certain fees and other costs. This makes it easier to compare different loans or credit offers, since APR gives you a more complete picture than just looking at the interest rate alone. Whether you're considering a credit card, a personal loan, or a mortgage, understanding APR is crucial for making informed choices. You might wonder why APR is so important. The answer is simple. APR helps you compare the true cost of different loans or credit products. Two loans might have the same interest rate, but if one has higher fees, its APR will be higher. By looking at APR, you can quickly see which option is more expensive over the course of a year. This transparency protects consumers and helps you avoid hidden costs. It's easy to confuse APR with the interest rate, but they're not the same. The interest rate is simply the cost you pay each year to borrow money expressed as a percentage of the loan amount. APR, on the other hand, includes the interest rate plus certain fees and other charges. This means APR is usually higher than the interest rate, giving you a more accurate picture of what you'll actually pay. There are different types of APR you might encounter. Fixed APR stays the same throughout the life of the loan, while variable APR can change based on market conditions. Some credit cards even offer introductory APRs, which are lower rates for a limited time before switching to the regular rate. Knowing which type of APR you're dealing with is important for managing your finances and avoiding surprises. When it comes to credit cards, APR is especially important. Credit card APRs can apply to purchases, cash advances, and balance transfers, each potentially with a different rate. If you pay your balance in full each month, you might avoid paying interest altogether. But if you carry a balance, the APR determines how much interest you'll owe, making it a key factor in managing credit card debt. For loans like mortgages, auto loans, or personal loans, APR gives you a standardized way to compare offers from different lenders. It includes not just the interest rate, but also points, origination fees, and other charges. This helps you see which loan is truly the best deal, even if the interest rates look similar at first glance. Now, let's talk about how APR is actually calculated. The basic idea is to take the total cost of borrowing, including interest and certain fees, and express it as a yearly rate. This calculation can get a bit technical, but understanding the basics will help you make sense of the numbers you see on loan documents and credit card offers. The formula for calculating APR is APR equals total interest plus fees divided by loan amount divided by number of days in loan term times 360, 5 times 100%. This formula takes the total interest and fees you'll pay over the life of the loan, divides by the loan amount and the number of days in the term, then annualizes the result. This gives you a percentage that reflects the true yearly cost of borrowing. Let's walk through a simple example. Suppose you borrow $1,000 for 1 year, pay $80 in interest and $20 in fees. The total cost is $100. Plugging these numbers into the formula, you get an APR of 10%. This example shows how APR captures both the interest and the fees, giving you a clearer picture of the true cost of the loan. The length of your loan, or loan term, can affect your APR. Shorter-term loans might have higher monthly payments but lower total interest, while longer-term loans can have lower payments but higher total interest and fees. APR helps you compare these options on an equal footing, so you can see which loan is truly more affordable over time. Not all fees are included in APR calculations, but many are. For example, origination fees, points, and some closing costs are typically included, while late fees or optional insurance might not be. Always check which fees are part of the APR to avoid surprises and make accurate comparisons. APR does not always account for the effects of compound interest, especially with credit cards. While APR gives you a standardized rate, the way interest is actually charged daily, monthly, or otherwise can affect the total amount you pay. It's important to understand both APR and how interest compounds on your loan or credit card. Lenders are required by law to disclose the APR on loans and credit cards. This helps protect consumers by making it easier to compare offers and understand the true cost of borrowing. Always look for the APR when reviewing loan documents or credit card agreements. For mortgages, APR is especially useful because it includes not just the interest rate, but also points, mortgage insurance, and other fees. This makes it easier to compare different mortgage offers, even if the interest rates look similar. Always use APR to compare mortgage options, not just the advertised rate. When shopping for a car loan, APR helps you see the real cost of financing. Auto loans can come with various fees, and the APR rolls these into a single percentage. This makes it easier to compare offers from different lenders and choose the most affordable option. Personal loans often come with origination fees and other charges. The APR includes these costs, giving you a clearer picture of what you'll pay over the life of the loan. Always compare APRs, not just interest rates, when shopping for a personal loan. Some credit cards offer special APRs for balance transfers, often with a low or even 0% introductory rate for a limited time. After the intro period, the APR usually increases. Always check how long the introductory rate lasts and what the regular APR will be after it ends. Cash advances on credit cards often have a higher APR than regular purchases and may also include additional fees. It's important to know the APR for cash advances before using this feature, as it can make borrowing much more expensive. If you miss payments or violate your credit agreement, your lender may apply a penalty APR, which is much higher than your regular rate. Always read the fine print and make payments on time to avoid triggering penalty APRs. Many lenders use promotional APRs to attract new customers. These offers might include 0% APR for a certain period, after which the rate increases. Always check the terms and conditions to understand when the promotional rate ends and what the regular APR will be. Variable APRs can change over time, usually based on an underlying index like the prime rate. If you have a variable APR, your interest costs could go up or down depending on market conditions. Make sure you understand how your APR is determined and how often it can change. Fixed APRs stay the same for the life of the loan or credit agreement. This makes it easier to budget since your interest rate won't change unexpectedly. However, fixed APRs may start out higher than variable rates, so weigh the pros and cons when choosing a loan. When comparing loans, always use APR rather than just the interest rate. APR includes fees and other costs, giving you a more accurate way to compare different offers. This helps you avoid surprises and choose the most cost-effective option. APR helps you estimate the total amount you'll repay over the life of a loan. By factoring in both interest and fees, APR gives you a clearer sense of your long-term financial commitment. Use APR to plan your budget and avoid overextending yourself. While APR shows the yearly cost, it also affects your monthly payments. A higher APR means higher monthly payments, while a lower APR means you'll pay less each month. Always consider how the APR will impact your monthly budget before taking out a loan. Your credit score plays a big role in the APR you're offered. Higher credit scores usually qualify for lower APRs, while lower scores may result in higher rates. Improving your credit score can help you secure better loan terms and save money over time. The amount you borrow can also influence your APR. Sometimes, larger loans qualify for lower APRs, while smaller loans may have higher rates. Always check how the loan amount affects the APR before making a decision. The purpose of your loan can also affect the APR. For example, unsecured personal loans often have higher APRs than secured loans like mortgages or auto loans. Lenders assess risk differently depending on how you plan to use the money. Loans secured by collateral, like a house or car, usually have lower APRs because they're less risky for lenders. Unsecured loans, which don't require collateral, often come with higher APRs. Always consider whether you're comfortable pledging collateral to get a lower rate. When shopping for a loan, always request the APR from each lender. This allows you to compare offers side by side and choose the best deal. Don't be afraid to ask questions if you're unsure how the APR was calculated or which fees are included. If you're considering refinancing a loan, compare the APR of your current loan with the new offer. Refinancing can lower your APR and save you money, but be sure to factor in any fees or costs associated with the new loan. Some loans include prepayment penalties, which are fees for paying off your loan early. These penalties may or may not be included in the APR calculation. Always ask your lender if prepayment penalties apply and whether they're reflected in the APR. Adjustable rate mortgages, ARMs, have APRs that can change over time. The initial APR may be low, but it can increase after a set period. Always review the terms of an ARM carefully and understand how your payments could change in the future. Payday loans often come with extremely high APRs, sometimes exceeding 300% or more. These short-term loans can be very expensive and should be used with caution. Always check the APR before taking out a payday loan and consider alternatives if possible. Student loans can have fixed or variable APRs and may include origination fees. Always compare the APRs of different student loan options and check whether fees are included in the calculation. This will help you choose the most affordable way to finance your education. Credit unions often offer lower APRs on loans and credit cards compared to traditional banks. If you're eligible to join a credit union, it's worth checking their rates before committing to a loan elsewhere. Online lenders are becoming more popular, and they often advertise competitive APRs. However, always read the fine print to ensure you understand all fees and charges included in the APR. Compare offers from multiple online lenders to find the best deal. If you're a business owner, APR is just as important when evaluating small business loans. These loans can come with various fees and interest rates, so comparing APRs helps you find the most cost-effective financing for your business needs. Understanding APR is a key part of personal finance planning. By knowing how APR works and how it's calculated, you can make smarter decisions about borrowing, budgeting, and managing debt. Always factor APR into your financial plans to avoid costly mistakes. If you're managing multiple debts, knowing the APR on each can help you prioritize which to pay off first. Focus on paying down debts with the highest APRs to save money on interest and get out of debt faster. Understanding APR is an important part of financial literacy. It empowers you to make informed choices, avoid predatory lending, and manage your money wisely. The more you know about APR, the better equipped you'll be to navigate the world of credit and loans. APR regulations are designed to protect consumers by ensuring transparency and fairness in lending. Always look for the APR on any loan or credit offer, and use it to compare your options. This helps you avoid hidden costs and make the best financial decisions. Smart borrowing starts with understanding APR. By comparing APRs, reading the fine print, and asking questions, you can avoid costly mistakes and choose the best financial products for your needs. Always use APR as your guide when evaluating loans and credit offers. To wrap up, APR stands for annual percentage rate and represents the yearly cost of borrowing, including interest and many fees. It's a powerful tool for comparing loans, credit cards, and other financial products. By understanding how APR is calculated and what it includes, you can make better financial decisions, avoid surprises, and save money over time. Thanks for watching, and remember to always check the APR before borrowing.